Hi, my name's Lucas Rogers and I'd like to welcome you along to the Rogers Property Group. Today I'm going to be covering 3 basic rules when it comes to property investment that are going to be able to speed up your property portfolio. And they're reasonably simple, and to be honest with you, they're common sense as well. When it comes to investing in property, there's one thing that you really need to focus on if you want to build wealth over the longer term, and that is capital growth. Capital growth is not taxed initially, so therefore it's better than a rental yield. And capital growth is also compounding over time as well. So if you're investing in property for the longer term, focus on capital growth. So that's rule number 1. Following on from that rule, where do you think the capital growth comes from when it comes to a property? All property is made up of 2 parts. First part is the land, and the second part is the structure that sits on top of that land. Whether it's a house, an apartment, townhouse, whatever that may be, it's all made up of the same 2 parts. Now, which part of that property do you think is going to grow the fastest in value? The structure or the land? I hope you've said land, because that's correct. The land is the commodity that they can't make anything else, or they can't make any more of. Okay, so it's very important that you focus on land, but not necessarily the size of the land. It's not really that important. What you need to be focused on is what we call land content. And land content is the value of the land divided by the total value of the property. And it's expressed as a percentage. Okay, so if I've got a house, the total property is worth $400,000, and I've got and the block of land that it sits on is worth $200,000. I do 200 divided by 400, and that gives me 50%. Okay, now 50% is an ideal land content ratio that we want to be looking at. And I like to look at anything between 30 and say 70%, anything within those parameters. So the first 2 rules are: 1, focus on capital growth. 2, where does the capital growth come from? It comes from the land. So focus on land content, not necessarily the size of the block. And our 3rd rule is something that you have to understand. And look, it doesn't matter what thing that you're investing in, whether it's shares, mineral, whatever it may be, there's a very, very simple economic equation that you can apply to that asset that you're looking at. An increase in the demand of that asset or product, plus a decrease in the supply of that product, is going to give us an increase in price. Increase in demand plus a decrease in supply is going to give us an increase in price. Okay, it's economics 101. So that's what we want to be looking at. So what creates demand in property? Well, demand in property is created by population growth. More people moving into a particular area means there needs to be more housing. And when there needs to be more housing, what we want to be looking at is, from a supply perspective, is where supply is not keeping up with demand. Okay, so where new house starts are not keeping up with demand, what that does is that creates what we call a supply deficit gap. And the bigger this supply deficit gap, the more growth that we can anticipate. So when you're selecting an area, so start off with your particular states, then look at your capital cities and then your suburbs as well, apply that criteria. Look at supply versus demand, and it will give you a very good indication of how much growth you can expect. I really hope this video has helped you out today, and I look forward to chatting with you again soon.